Marvell Technology, MRVL. Stock is currently trading at 64.67 in pre-market, up 0.07 or 0.1% from its last close, hovering within a day's range of 61.8, 1 to 64.66. This seemingly calm, fractional move belies a much more turbulent reality that has been playing out behind the scenes. The mainstream narrative following Marvell's recent Q2 fiscal 2026 earnings report was one of disappointment. A story of an overhyped AI play failing to deliver on the lofty promises of the bull market. The stock plunged almost 15% after the announcement, with analysts cutting their price targets and market sentiment souring. That is the expectation. But the reality is far more complex, and for the discerning investor, profoundly more interesting. The drop wasn't a sign of a broken business, but rather a violent, knee-jerk reaction to a single, nuanced point of guidance that the market chose to interpret in the most pessimistic way possible. This creates a critical tension between the surface-level panic and the underlying fundamental strength of a company that is, in fact, growing at a historic clip. Core business slowdown? The common belief is that Marvell is facing an insurmountable slowdown in its core data center business, particularly from hyperscalers like Amazon Web Services. This is the simple, emotional takeaway from a market that has been trained to react to forward guidance with an almost Pavlovian response. But dig deeper, and you see a different picture. The company's Q2 revenue was a record-breaking $2.006 billion, exceeding the midpoint of its own guidance. This represents a staggering 58% year-over-year growth. The non-GAAP EPS of 0.67 was also a record and perfectly in line with expectations. So, where did the disappointment come from? It stemmed from the Q3 guidance, which projected data center revenue to be flat sequentially. In the age of hyperscale AI build-outs, flat is a four-letter word to the market. But here is the critical insight. This flatness is not a sign of a structural decline in demand. On the contrary, Marvell's CEO Matt Murphy explicitly stated that the underlying custom AI design activity is at an all-time high, with over 50 new opportunities across more than 10 customers. The sequential flatness in data center revenue for Q3 is a temporary project-based lull, not a long-term trend. The market, fixated on the quarter-over-quarter optics, completely missed the bigger, more powerful story of the company's pipeline filling up with long-term, high-margin custom silicon contracts. This is the difference between a trader's time horizon and an investor's. While the former sold off in a panic, the latter should be viewing this as a rare opportunity. Institutional activity. The trading volume in the wake of the earnings report was massive, with institutional investors showing a fascinating mix of reactions. Major players like T. Rowe Price and Goldman Sachs trimmed their positions, likely in a risk-off move to de-risk portfolios after the guidance shock. This explains the sharp, dramatic sell-off. However, other behemoths, including UBS Asset Management and DZ Bank AG, dramatically increased their stakes, adding millions of shares to their portfolios. This divergence in institutional activity speaks volumes. The smart money isn't unified in its pessimism. Some funds, driven by quarterly performance targets and macro concerns, are fleeing, while others are seeing the deep value and long-term potential in a stock that has been unfairly punished. This creates a supply and demand dynamic that, while volatile in the short term, sets the stage for a powerful rebound when the market inevitably reevaluates its overreaction. The stock has been trading with a high beta of 2.31, indicating its tendency for exaggerated moves relative to the broader market, which is precisely what we have witnessed. It has fallen by over 11% in the past week, and more than 16% in the last month, a testament to the brutal repricing that occurred. Yet, it remains more than 25% above its 52-week low, showing that the bears haven't been able to push it into a full-blown capitulation. Long-term fundamentals. Beyond the immediate market drama, the fundamental business of Marvell Technology is deeply rooted in the most critical technological trends of our time. The company is a leader in data infrastructure semiconductor solutions, with a portfolio that spans from the data center core to the network edge. It is a pick-and-shovel play on the AI revolution, but not in the way many people think. While a company like NVIDIA provides the picks, the GPUs that are the engines of AI, Marvell provides the shovels, the custom silicon, high-speed networking, and optical interconnects that make these data centers function at a massive scale. Their revenue is now 74% derived from the data center segment, a clear signal of their strategic focus and success. Marvell's core offerings include a comprehensive suite of Ethernet solutions, custom application-specific integrated circuits, ASICs, and security solutions like their liquid security HSM adapters. The company has also been strategically divesting non-core assets, such as the recent sale of its automotive Ethernet business for $2.5 billion, to sharpen its focus on its most profitable and high-growth segments. This is a company that is actively optimizing its business model for the future, not one that is flailing. The fact that the market punished them for a temporary Q3 guidance issue, even as they reported a record-breaking quarter and are making savvy strategic moves, is a stark example of the disconnect between short-term noise and long-term signal. Future outlook. The future outlook for Marvell Technology is built on a few powerful pillars. The first is the relentless demand for AI infrastructure. Even with a temporary pause from one or two customers, the overall build-out of AI-centric data centers is a multi-year secular trend. The complexity and scale of these operations require highly specialized, custom silicon, and Marvell has positioned itself as a key partner to the world's largest hyperscalers. The company's custom AI design wins are a forward-looking indicator of significant revenue streams down the road. This is the long-term reality that the market is currently underestimating. The second catalyst is the ongoing build-out of 5G infrastructure and enterprise networking. While the data center gets all the headlines, Marvell's products are also essential for enabling the next generation of wireless and enterprise connectivity. The company is poised to benefit from both the AI boom and the broader digitization of the global economy. Risks, of course, are present. A deeper, more prolonged slowdown in global enterprise spending, driven by macroeconomic headwinds, could impact demand. Competition from rivals like Broadcom and NVIDIA is fierce. And the volatile nature of the semiconductor industry means that any missed target or weak forecast can be met with a disproportionate stock reaction. However, the current valuation, post-sell-off, reflects much of this pessimism. The consensus analyst price target has fallen to an average of around 86. But even at this reduced level, it represents a substantial upside from the current trading price. The most bullish analysts still see a path to over 120 per share, a return to its pre-sell-off glory, suggesting that the long-term case remains intact. Market disconnect. In this context, the recent price action is less a sign of Marvell's failure and more a reflection of the market's collective short-sightedness. The tension between the expectation of flawless, linear growth in a high-flying sector and the reality of a lumpy, project-based business model has created a significant dislocation. This is where opportunity is born. For those willing to look past the dramatic headlines and the immediate, emotional market reaction, Marvell presents a compelling case. It is a company with a strong and growing business, a strategic focus on the most important technological trends, and a long-term pipeline of custom design wins that will fuel future growth. The question isn't whether Marvell is in trouble, but whether the market will soon recognize the difference between a temporary headwind and a fundamental breakdown. The historical precedent in the semiconductor sector suggests that corrections like this are often followed by powerful rallies, as the true value of the underlying technology is reappreciated. Technical indicators. As we look at the trading landscape, the technical indicators are a mixed bag, reflecting the recent volatility. The stock has broken below a key support level and is showing strong negative momentum, with its RSI in oversold territory. For some, this is a sell signal. For others, it's a contrarian buy signal, a sign that the panic has gone too far and a bounce is likely. The average true range is wide, confirming the high volatility. The institutional ownership data is particularly telling the fact that some of the largest, most sophisticated investors are adding to their positions, while others are selling, creates a unique friction that is worth watching. The company's recent divestiture of its automotive segment also highlights a crucial point. Management is actively shaping the business to be as lean and focused on high-margin, high-growth areas as possible. They are not just sitting back and reacting to the market. They are making proactive, strategic decisions that should pay dividends in the long run. The disconnect between a well-managed company making smart moves and a market punishing it for a short-term blip is a classic tale in investing. Conclusion. Ultimately, This is a story about a company with a strong foundation that has been temporarily knocked down by a market that demanded perfection. The expectation was that Marvell would deliver a perfect, high-growth quarter and an equally perfect, high-growth outlook, especially with the AI narrative at its peak. The reality was a record-breaking quarter accompanied by a more cautious but fundamentally logical short-term forecast. This gap between expectation and reality is what caused the violent stock move. The long-term trajectory, however, points to continued expansion fueled by the insatiable demand for data infrastructure. The company's focus on custom silicon for hyperscalers and its leadership in high-speed networking are not trends that are going away. They are foundational to the future of technology. So, before you write this company off, consider the full picture. It's a testament to the saying that the market is a voting machine in the short term, but a weighing machine in the long term. Marvell is a heavy piece of metal, and sooner or later, its weight will be recognized.